A high yield isn't everything when it comes to investing in dividend stocks, and this is especially true if you're investing in your 20s and 30s. In fact, if you have decades left until you can live off of your dividend income, which is the case for most of us within that age range, then you'll benefit most by buying high growth stocks that offer regular dividend increases over the long haul, like the kind we'll be talking about in this video. So without further ado, let's get into it. All right, guys, now the best dividend stocks in general are the ones that will be able to increase their dividend payouts year over year and decade after decade like clockwork, even if they start out having dividend yields that are on the lower side. I mean, take Lowe's, for example. This is a company that offers a 2.39% dividend yield with 58 years of consecutive dividend growth. So Lowe's has proven itself able to continue delivering increased dividend payments as time goes on. And furthermore, as we can see, that 5-year growth rate is astronomical, 18%. Now, as far as the dividend yield alone goes, you might not think that's anything too out of this world, which it's not, especially when you compare that to a different company, a high-yielding company like Main Street Capital Corporation, which has a forward dividend yield of 6.69%. So nearly 3 times the dividend yield. And you might compare these two companies and say, oh, well, I'm going to be better off investing in Main Street because the dividend yield is 3 times as high. So I'm going to be able to generate 3 times the amount of dividend income, which, yes, is true in the short term. Today, that is the case. But guys, we need to zoom out over a long period of time. We're only in our 20s and 30s. Remember, we have decades left to invest, so we need to think down the road. And to demonstrate that, guys, we're going to take a look at this dividend calculator right here from marketbeat.com. And here I've plugged in 2 different scenarios: the dividend income growth from investing in Lowe's and the dividend income growth from investing in Main Street Capital Corporation. And in this scenario, guys, we've accounted for $1,000 invested with an annual contribution of $1,200 or $100 every single month. And we're going to take a look at this over a 25-year period of time. And starting with Lowe's here, let's scroll down and just take a look at the first few years. So after year 5, you'll have an annual dividend income of $225.94 from investing in Lowe's, compared to Main Street Capital Corporation. If we go over here after 5 years, you'll have nearly $200 more from investing in Main Street, the higher yielding company, guys. So in just the first few years, it looks like Main Street Capital will take the cake, but let's keep going down. Let's go down to let's say year 10. So in year 10 with Main Street Capital Corporation, you'll be bringing in $867.53. Now bouncing back over to Lowe's, going down to year 10, look at that, $893.81. So after 10 years, they're about even. And actually, at this point, Lowe's is taking the cake. Lowe's is officially, after 10 years, bringing in more dividend income for you than the higher yielding Main Street Capital Corporation. And let's scroll down all the way to the bottom and see what after 25 years looks like. So investing in Lowe's for 25 years, you'll end up with $32,441.96 compared to Main Street Capital Corporation. If we scroll down after 25 years, according to this, you'll only have $2,430.68. And the reason this is the case, guys, is because Lowe's has such a high dividend growth rate. It continues to increase its dividends year over year over year and decade after decade, nearly 60 years at this point, and not just by a little bit, by a lot. Remember, in the last 5 years, it has a 5-year growth rate of nearly 18%. That's a lot of growth. And what happens is these regular dividend increases over time will lift the dividend yield on your original cost basis. And this is what we refer to as the yield on cost. And to give you an example of this, guys, let's say that you buy a stock that's priced at $20 per share, and for every share you own, you're getting $50 every single year in dividends, which would result in a 2.5% dividend yield. But then let's say next year, this company decides to raise their dividend by 25 cents per share. And now for that same $20 investment that you used to buy the share, originally yielding 50 cents per share, now 75 cents per share, that's going to raise the dividend yield on your original investment from 2.5% up to 3.75%. Do you see how this works? And if you stick with it long enough and you let compound interest in time do their thing, then your original, small, measly 2.5% dividend yield can grow into, double digits. And the key component here really is time. If you're someone who is closer to retirement, then you don't have the time to let the growth compound. So you might be better off investing in higher yielding dividend stocks that are going to give you a better return today. But as younger investors, we are lucky enough to have time on our upside, which when deployed with patience and consistent contributions in your portfolio will yield great returns. And now guys, moving on, I want to share with you a few really great high growth dividend stocks that I think make for great investments for someone in their 20s and 30s who have a lot of time to let that dividend income grow and compound. The first company I want to share, and I know we've already mentioned it, but I'll touch on it again, is Lowe's. This is an awesome company. Nearly 60 years of consecutive dividend growth with a near 18% dividend growth rate. That is really hard to beat, guys. And moving on, the next company is Abbvie, ticker symbol ABBV. This is a company in the healthcare sector, and they have a actually pretty decent dividend yield, 3.66%, but look at that growth rate. Super high, 17.5% with 9 years of consecutive dividend growth. Moving on to the third one, we have StarBucks, which is one of my favorite companies, guys. Once again, super high dividend growth rate, 15.11% with a dividend growth history of 12 consecutive years. The fourth one is looking very similar. We have Snap-on, ticker symbol SNA, which has a dividend growth rate of nearly 15% with 12 years of consecutive dividend growth. And last but not least, we have Lockheed Martin, ticker symbol LMT, with a dividend growth rate of 9.12% and a dividend growth history of 20 consecutive years. And just so you guys know, these are all companies that I have in my own portfolio. I'm buying more Lowe's, I'm buying more Starbucks. I'm definitely trying to swoop up some of those high growth dividend stocks. And now moving on, guys, let's say that you're going to invest in these 5 companies and also a handful more, because I put together this little sample portfolio with 10 different stocks. And in addition to the 5 we've already talked about, we also in here have Altria Group, we have Microsoft, Parker Hannifin, Abbott, and Union Pacific, all very high growth dividend stocks, as we can see from this column right here. But let's say you're going to invest $1,000 into each of these 10 companies. Let's see what that portfolio might look like 25 years down the road. Kind of the same thing that we did earlier in the video with Lowe's in Main Street Capital Corporation. Now, scrolling down, let's take a look and see how this portfolio will grow after 25 years. I mean, we can see here in the first year, your annual dividend income is nothing too crazy. Okay, about $300. And between year 1 and year 2, it's not growing that much, an extra $85 between those years. And the same is going to be true as we continue scrolling down. There's really not too much growth until we get down to these later years where we're starting to grow by multiple thousands of dollars in dividend income just from reinvesting those dividends and making that $100 contribution every month. Between year 20 and 21, we're growing by about $4,000. 21 and 22, about the same. Between 24 and 25, you're seeing a growth of nearly $10,000 just in 1 year. And ultimately here, you'll end up with about $45,375 in annual dividend income. So that's pretty substantial if I do say so myself. And furthermore, look at how this yield on cost is growing, because that's, you know, an important metric that we touched on a little bit earlier. You're starting at about 3%. That's your initial dividend yield, but then scrolling down, that's going to continue growing over time. And within 10 years, you're at a double-digit yield on cost. And furthermore, if we go down all the way to the bottom, your yield on cost ends up at 116.95%. Insane. So hopefully that makes sense, and I hope you guys enjoyed learning about the best dividend stocks to buy in your 20s and 30s. And now with that behind us, click on this next video to learn about the best dividend stocks to buy right now in the month of July. So check it out right here, and I'll see you in the next one.